you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over. Just let me in your head, so I can be there for you, there for you. The night is young, won't you sing for me? Won't you sing for me? Feel we fall asleep. The night is young, won't you sing for me? Won't you sing for me?
Hello, everybody. Welcome to VC Masters on the Pod TV network. I'm Nick Palavito. I'll be one of your hosts for today. And today, of course, we'll look at some breaking news relating to venture capital. And with that, we're going to be bringing the VC Master himself, who is a professor at Duke University and heads up the Azimuth Fund, none other than Dr. Salman Azar. Dr. Azar, welcome to the VC Masters. So what's the latest and greatest news in the world of venture capital and private equity? What do we have that's going on?
Well, there's not a lot going on. Everything is kind of in a holding pattern while all these wars are being fought. And a number of companies that were planning an IPO in Q2 and even late Q1, they have put that on hold, which is an interesting proposition because it generally reduces their pricing in secondary market, which actually helps us because we buy off the secondary market, and I can explain what the secondary market is in just a few minutes. But it also has the other aspect of it, which is that some of these delays are causing a lot of liquidity strain in the private markets in general, whether it's PE or VC and so on. More so in VC because we rely on IPOs as liquidity events or acquisitions, whereas PE generally has lower appreciation but does have cash flow.
So are we seeing a slowdown now in the VC market? I heard that there's a SpaceX that's going to be going public shortly, or is that on hold? What's going on the IPO market? Are we just getting into a slowdown?
Yeah, it is definitely a slowdown. I don't have inside information on SpaceX and what its plans are, but the company that I do have inside information, they are kind of like in a holding pattern. It is quite possible that SpaceX would go public. It doesn't make sense for anybody to go public, at, let's say, today. Tomorrow, our president may change his mind and it would be, business as usual. But let's say just focus on today because anything can happen tomorrow that can really impact the general market. And you don't have to have an IPO that kind of goes out and then kind of tanks. So, and maybe stepping back a little bit on this one, the idea is in an IPO that, let's say if you go public at $50 a share, you want to have at least a steady rise up. You don't want to go public at 50 and then tank to 45 or 40 because it starts a downward momentum that is very hard to catch. So companies generally like to go public in a stable market where there is less risk of downturn. Yeah, go ahead. Yeah.
Yeah. What though about the private equity market? Are we seeing a lot of activity in private equity? I know that my company, I get approached all the time by private equity that is asking to buy my company. In other words, are you seeing a lot of activity in the private equity market?
Actually, it is out of this. I mean, like our companies are not for sale to private equity, and I can explain why. But we are receiving so many random emails, and they just look like spam. I have a nonprofit called Bay Area Chess, and I am receiving offers for a nonprofit, which is like, sorry, this is a nonprofit. Well, actually, I ignore that, but I can't help but myself think that, do they even check the registration of this company? Do they even know what we are? It's just spamming all over the world. And that's basically what's happened in the PE market. What's going on is that, there was this transition called the baby boomer transition where a lot of people were retiring and baby boomers were retiring and then selling their businesses. And that kind of started this whole ecosystem of entrepreneurship by acquisition. And that's basically now, it doesn't have a place to go because all those baby boomers that were planning to sell have already sold or passed it on to the next generation. And there may be a few that are still running. So there is like a shortage of supply there. So the private equity, or I wouldn't even say these are private equity, these are usually small fund, they call them search funds, and their job is to search for opportunities. And they would go and emails to people like you and me, even though we are not selling or we are not anywhere close to selling and making. I mentioned the VC companies that are backed by venture capital are usually not interested in a private equity firm acquiring them, because when private equity firm acquires, they typically want a 51% of the shares, and they want a controlling interest. And most of these companies are relying on the founder and their knowledge and their passion. Most of the VC companies are relying on the founder and their knowledge and their passion in order to grow. So we as VCs invest in companies that may not be profitable right now, but we are investing in them because the founder has an incentive and a majority share, well, a larger share than other investors, and would be interested in growing them.
Yeah, another movement, it looks like we just got a statement from the Department of Labor that they're going to allow venture capital funds to be placed into retirement plans, which for years they refused because of the lack of liquidity in that. Are we going to see that in the future, that the 401k plans and the profit sharing plans that are out there start buying into venture capital funds? Is that going to be the wave of the future?
Well, they're already doing that, because there are some funds that buy this that are publicly traded, that basically buy privately held companies, mostly PE. So definitely, I think that's going to be something that we are going to see more and more of as things kind of progress. There are also other ways that companies are seeking liquidity rather than going public. They are tokenizing on blockchain and kind of starting an activity, but those don't give access to a number of retail investors. So it's not quite as good as going public, but it can sometimes mean that you can sell some chunks of shares. The bid-ask spread on these is fairly high, so it doesn't make sense to buy unless you can get at the bid value, because the ask are usually much higher, and vice versa, the same thing, kind of like. And by the bid-ask spread, I mean, if let's say if I'm selling a car for $50,000 and you are willing to pay $30,000, that's like a huge spread, and that transaction is hard to happen at a good market price. It's very difficult to determine a market price. You would say, okay, the transaction should happen 50,000, but between 30,000 and 50,000, which means 40,000. But then you are not going to raise your bid to 40,000, and I'm not going to lower my ask to 40,000, and the transaction or the sale would not happen in those cases.
Mm-hmm. And when you're looking at your VC, what sort of sectors are you looking at right now? Are you looking? I had one person approach me with defense contracting, believe it or not, and I never thought that would be a sector, but given what's happening in the instability of the world, it might be a good sector. Are there any particular sectors you're looking at right now that might be a place to park funds?
We have always been sector agnostic, and that actually is a good strategy for us because it helps us diversify as well naturally. So we are not looking at any particular sectors, but the defense contracting and defense sector in general is the only sector that is benefiting from the war, as far as I can tell. I mean, there may be other sectors at the second level or the third level that are benefiting, but they are the direct beneficiaries, which means, in fact, there was like a news item that some politician bought some shares in some defense companies just before the war, or mutual funds or ETFs or something like that. So defense sector is kind of hot these days. The other sectors, defense and AI. AI is kind of still, has been hot for like the last few months. There's a lot of highly technical world. There's a lot of crappy companies in AI that are getting large investments, which is really sad because it reminds me of the .com bubble. That there are some solid companies there, and it makes it difficult for them also to raise, at their correct valuations, while all these companies with blah blah.ai. I was going to say X.ai, but X.ai is actually a real company. But blah blah.ai can raise a few $1 million just for having .ai in their name, just like .com was a thing in the 20th century.
And what about scaling companies? I also get reports that, well, I can take your company and scale it and move it up to these huge valuations. Are you looking at companies that can be scaled upwards? In other words, where they can, and that's one of the advantages of computer chips and software, is that once you develop it, you don't need to hire a lot more people to scale it upwards. Are you looking for companies that can be scaled upwards?
Definitely. In fact, the only companies we look at are the companies that can be scaled upwards. One of our criteria is that we want a 30 to 50% year-over-year valuation growth, and that valuation growth can either come from revenue growth or it can come from increased profitability. In growth companies, it's a combination of the revenue growth and profitability that defines the value of the company. So when we are looking at these things, we are really looking at companies that are in high growth mode and late stage also, which sometimes makes it very difficult to find. So for example, out of about 300 companies, we generally find single-digit companies that meet our criteria of growth at a late stage. Growth is much easier when you have a revenue of $1 and you double it to $2, but it becomes very difficult when you have $1 billion in revenue and you want to double it to $2 billion. So those are the kinds of companies we look at. We are agnostic about the sector, but with that kind of growth, it always has to have some technology component, because like a restaurant is very, a late stage restaurant is very hard to grow at 30 to 50% year over year. You have to have some kind of a technology component that will help it scale without adding, the same level of manual growth. So for a late stage restaurant to scale by 30%, you have to add 30% more staff, you have to have 30% more customers, and that just becomes very difficult when all of these things come together. But when you have technology involved, the technology can help you scale without adding and hiring additional people.
Yeah, and also when you're looking at a company, are you looking for trade secrets, or trade secrets have any value at all? Because there's some recent reports that they're easily stolen. In other words, how do you protect the trade secrets as opposed to patents?
Yeah, so a lot of software companies rely on trade secrets, because if they actually register a patent, it becomes very easy to duplicate. And that makes it very difficult to file for a patent and still be able to protect what your intellectual property is. So trade secrets are often used in software companies. Sometimes it's very easy to scale. There are lawsuits and stuff like that happen in those cases. And that makes it very difficult to then get those back and so on. So there are several ways to protect IP. The most common is registering a patent, in which case you have to disclose, and trade secrets, basically where you say, okay, this is something that's a secret and you cannot share it with anyone. California has actually very loose trade secret laws. Essentially, what it says is that anything that is in your brain, you can take it. So if I learn something at company ABC, and I move from ABC to DEF, whatever is in my brain, I can take it. I cannot take my code that I have written or financial data that I have, and so on and so forth. That is basically where trade secret gets some protection. But otherwise, it's hard to. You're right. It's hard to protect trade secrets.
Mm-hmm. And what about companies that have acquired a lot of debt? Another thing I'm approached all the time is to borrow this money, or I'll fund this money, and it's always this debt financing. What's your thoughts when you approach a company, but they're loaded with debt?
So companies often believe that debt is actually a cheaper financing method than equity because you don't have to share the upside. So when a company is growing, debt becomes a very attractive method for company. And then it really becomes a question whether this company can service that debt or not. In venture debt, most of the companies that are there are happy to work with you if you are unable to pay that debt. So generally, we are not too concerned about debt unless it's really weighing down a company. Another form of debt in venture capital is convertible notes. Convertible notes is debt that gets converted at certain triggering events. And most of the time, this triggering event is a priced round. So convertible note basically says, I am going to invest, let's say 100,000 or a million, 10 million in your company, and that is going to be debt for the company. And then at a later time, when let's say you have another funding round, then that debt gets converted. And let's say that funding round is at $10 per share. So the debt would get converted into equity for $10 a share. So we see most of the debt, in fact, we see is that kind of debt, which is convertible notes.
Okay, another thing that's on everybody's mind is NVIDIA. NVIDIA came out of nowhere, and then all of a sudden it becomes $1 trillion corporation. How do you spot a NVIDIA before it becomes a NVIDIA, or can you spot a NVIDIA before it becomes NVIDIA?
Well, you can kind of have some idea where companies can have growth or not, but it is very unlikely that you can make accurate predictions. So, for example, I didn't think Google would be a huge company. I was approached a long time ago about, they're going to make their money by search. And at that time, Yahoo and some other companies were in search. And my reaction was, you cannot make money in search. So that was the end of that bad decision. And companies like NVIDIA, the thing that doesn't surprise me about it is that when I was in Silicon Valley, it was really hiring the top talent, and it was well known that it is hardest to get an offer from NVIDIA. So that kind of indicated to me that this company is going somewhere, but I didn't expect it to go where it is right now. And I don't know if anybody did, and there are obviously people that are going to claim that they did, and all you need to do is ask them, how much did NVIDIA stock did you buy when you found out that it is going to go places? So I thought it was a good tech company. I had a Silicon Valley bias against hardware. So Silicon Valley has a bias against hardware because it is harder to scale hardware. It is harder to double the production of chips, for example. But it's easier to double the usage of software. So Netflix is kind of like an interesting example, is that for them to add an additional user doesn't take any new thing, and it just takes a little bit of bandwidth, a little bit of hardware for them to add a new user. So every user is very profitable, and the growth can kind of scale really easily. Whereas when you compare that to a hardware company like NVIDIA, the bias in Silicon Valley would be is that in order for them to double their sales, they have to double the chip production, which in itself is a much harder problem. You just can't copy and deploy more, very easily like software can on additional servers and so on.
Okay, another sector that's hitting LinkedIn a lot is biotech, and some of the claims are kind of outrageous, but I'm not really sure. One claim is that people are inventing anti-aging pills, okay, and claiming that people could live to age 200 if they take such pill. Another one says that they are curing cancer, but it hasn't been FDA approved. Are you looking at these biotechs? Is this going to be the next big sector, or is it going to be all smoke and mirrors?
I have given up on predicting future, but at the same time, biotech is one of the fields that is always going to be necessary and would have the demand, because human beings want to be healthy and live a long life, at least a long, healthy life. And that would make biotech always valuable if it has a value to deliver. Whereas, something that is a luxury may not have that. So, for example, the demand for Lamborghinis may go down at some point, but, depending on how people value Lamborghinis. And we always have like these brands that kind of go out of favor and so on. Blockbuster is a classic example that was eaten by Netflix. But when it comes to biotech as a sector, it will always have a value, because the value that people associated with their health and life is higher than anything else except money. So money is like the number two, which kind of tells me that fintech and so on would always be there. In fact, our top two companies right now, one is effectively a biotech company. It's about making light healthy. And the second is a fintech company, which is financial technology, which helps people with loans and buy now, pay later, and so on and so forth, because people value money as well and comfortable life. So when it comes to an individual company in biotech, I'll have to look deeper into what it is, but biotech would definitely be a sector that I would be interested in exploring more. If a biotech company would be definitely a company that I would be interested in exploring more. Whereas, there are other sectors that I think are kind of like fading away. That like automobile is an interesting sector. I feel that once we have self-driving cars, a lot of people would not have cars. I would not have a car, because I would actually have Uber pick me up and drop me off. Right now, the biggest cost in Uber is the driver itself. And if you eliminate that cost, Uber becomes very cheap. And now the whole neighborhood can share cars. And, some people obviously would have cars for vanity reasons, but for practical reasons, the cars would not be necessary.
Yeah, you also mentioned earlier in the show that that venture capital takes a minority interest where private equity takes controlling interest. But as a minority interest shareholder, don't you feel like you're subject to the whims of management when it comes to doing the investment?
Yes, definitely. So, minorities, whether you are a shareholder, whether you are race, religion, whatever, always are less protected. And there are provisions in VC documents that protect those minorities. So some, it may be through voting shares, it may be through board controls. For example, even though an entrepreneur may have, or the founders may have more shares, the board positions are going to be evenly divided between the investors and the founders. And there's going to be a neutral party that both of them agree to for the casting board. It is much more risky business, and it is not something that you can just get up one day and say, I'm going to be a VC. It requires you to have like a very strong network. I do not invest in companies that I do not know the founder for ages. It's simply like, I get all, you talk about like offers to buy. I get also all these like spams of, invest in my company and I will give you blah, blah, blah terms. And I do not know whether that is fraud or that is like, the quality of the entrepreneur is bad, et cetera, et cetera. So it is very simple that, I would only invest in people that I have worked with directly already. And these are companies that, these are founders who I've already invested previously, or they are founders that, are known to people I know very well, and they basically can vouch for them. So if you don't have anybody to vouch for you, it's not worth my time to even look at it, because to your point, when you are kind of taking a minority interest, you are running the risk of a lot of either fraud or incompetence that you invest in.
Yeah, last question deals with venture capital versus the S&P 500. A lot of the money managers say, well, the S&P 500 beats everything out there. But then I did look at a study that showed venture capital actually has beaten the S&P 500 over the last 10 years. And we know this year it hasn't been good for the S&P 500. So what are your thoughts on venture capital versus the S&P 500?
Yeah, it's an easy win for us. It's like an NBA team playing a Division II basketball team, honestly. That the kind of companies that we get are really high growth compared to S&P 500. And depending on what stage of VC you enter in, and maybe this is a topic for another show, is that in early stage, your upside is much higher, but at the same time, your risk is much higher as well. So, and if in late stage where we are, the upside is not going to be that high, but we are rarely going to make anything less than 2x on our, a lot of bad things need to happen for us to do anything less than 2x return.
Yeah, well, I do like that type of return. And right now we're going to return back to our regular scheduled programming. We want to thank Dr. Salman Azar, who's the head of the Azimuth Fund and also a member of the Duke faculty, and our viewers in the United States and also around the world. We'll see you next week on VC Masters on the Pod TV network. Till then, have a good week. Bye-bye.
I go anywhere with you, 'cause you fill my mind, or you fill my mind. We could build a dream, start up something new, and the world is on your shoulders, and you feel like falling over.